Hello and welcome to this week's Ferrari Financial US Market News Summary. Well, it was a bad week on Wall Street this week to open the year, really. Not the sort of start to 2008 we'd really want to see, but we were expecting it. The market basically sold off all week, but particularly on Friday, of course, with the release of the employment data, the market really decided that it looked bad for the US economy going forward into the first quarter and reacted accordingly. As the Federal Reserve's next meeting isn't until the end of this month, it's likely that the market will look towards the start of the earnings season shortly, the reporting on the company results for the last quarter of 2007, and that will really determine market sentiment going forward. But our feeling is that the market won't be too pleased when they hear those results. We can't really see that corporate earnings can be very buoyant, considering the very high price of oil throughout the latter half of last year. And of course, this week we had that momentous $100 a barrel hit for the first time. There are other inflationary concerns as well. The price of wheat, the price of lots of commodities, metals, etc., being at a very, very high level at the moment. And even the technical picture isn't looking very good. If we now take a look at our Nasdaq Composite Index chart, you'll see exactly what we mean. I'd like to take a look now at the one-year chart for the Nasdaq Composite Index, so we can really zoom in on this head and shoulders reversal pattern, which is the pattern that we've been predicting for some time now for the market to reverse direction. And this has in fact happened over the holiday period. It all started back in July and August of 2007, when we had the left shoulder being formed at the first breaking of the subprime mortgage problems. That news caused that sudden drop in the market and formed the left-hand shoulder. And then we had a rather nice autumn rally, certainly in tech stocks, which took the market back up again to new highs and formed the head of the pattern, which is this area here, before Christmas, where we quite accurately predicted that the market may well then form a right-hand shoulder. So we were expecting a little bit of a pickup before Christmas, and over the Christmas period it continued before falling away coming into the New Year period. And in fact, the sharp drop at the end of last week, particularly on Friday, when the Nasdaq on one day dropped nearly 100 points, this penetrated what was effectively the neckline. This line here is the neckline of a head and shoulders pattern that has now formed and is a very significant line to be penetrated. We do feel that there is little chance now of the price channel that was formed over the last 2 months continuing, because the penetration seems to be quite certain here. So there's less likelihood that this is just a continuation of a consolidation phase. More likely that selling will continue into the new year a bit further down, before then some sort of rally will be attempted to bring the price back up again to touch, or in fact just go over by a short measure, the neckline line here, which will then probably signify the market turning south again and falling away in a more prolonged downtrend. So it does look very much like the head and shoulders reversal pattern that we've been predicting now for several months and watching unfolding has in fact occurred. The right shoulder has formed now, and this has formed really over the Christmas period, and the sharp drop on Friday has now in fact dropped the market through the line that forms the neckline of this head and shoulders pattern, and that really completes the head and shoulders reversal. The unfortunate thing is that this is simply a warning or a portend for the market to fall even further in the coming months. What we expect to see happening now is maybe after another small drop, we could well see a rally attempt to bring the market back up to at least the neckline, or maybe a little past the neckline level, before then turning south again and starting a longer downtrend. Not a good start then for 2008, and particularly not good news for anybody with a standard stock portfolio, or in fact heavily invested in standard investment funds. They're all likely to suffer quite dramatically in the next 2 to 3 months. Here at Ferrari Financial, of course, we have predicted this market reversal for some time and pretty well nailed it in terms of timing it. So that all of our subscribers should have made good profits from short trading over this last 2 to 3 months. Now comes the difficult task of watching how far this market is liable to fall, and then obviously timing an attempted rally, or in fact the end of what could be a fairly short bear market. Let's hope so. Anyway, until next week, it's goodbye from London.